Okay, ready to go. Okay, good evening, everyone. Everyone hear me okay at the back? Okay. I'll just let everyone sit down and then we'll... Okay, good evening, and thank you for coming. For those of you who don't know me, my name is Scott McKenzie. I'm the regional manager here in Ontario. If you don't know me and you want to say hi after, come on up, and I'm happy to talk to anyone who'd like to share any stories or feedback. So it's my pleasure to kick things off this evening with some brief opening remarks on why we're here and what's in store for you. For those of you who may not be familiar with our firm, for more than 40 years, TE Wealth has provided individuals, families, and businesses with truly objective financial advice and education. Our fee-based approach to wealth management is centered on providing high net worth individuals with comprehensive guidance rather than promoting financial products. In fact, our founder, Timothy Egan, trademarked the term fee only to describe the uniquely independent counsel that our clients receive. We believe that our complete focus on meeting the needs of our clients is the reason they chose to work with us and the reason they stay with us year after year. Recently, we've had discussions with many of our clients, and hopefully some of you in the room, and we wanted to ask them what they want from their financial professionals, among other things. One clear message that stood out above the rest that we heard, that is that clients want to learn more about how my colleagues and I at TE Wealth assess, select, and manage investments. Clients want to understand more of the why, the how, and the when of our investment philosophy. So tonight we're going to talk about exactly that with a two-part presentation. First up is Winston Mundy, who's an investment counselor in our Toronto office. Winston's going to review market conditions from 2012, and then he's going to share his guaranteed 100% outlook for 2013. So if you have any extra coin lying around and you want to fail-safe proof, Winston is willing to guarantee it. After that, we'll lead directly into a dynamic presentation on tactical asset allocation strategies by Tyler Morty. And Tyler is the Director of Research at Hahn Investment Stewards and a sought-after expert on global investment strategies and ETFs. I think many of you might have recognized Tyler's name from paper. He's quoted quite a bit on the subject. So I think you'll find the combination of these two presentations to be a powerful one in answering those why, how, and when questions that many of you have. So I think I'll just hand it over to Winston and we'll get going. Okay, thank you.
Thanks, Scott. I'm not sure about the guarantee, though. Good evening, ladies and gentlemen, and welcome to our market recap and outlook for 2012 and 2013. Tonight, I'd like to review market events of over the last year in greater detail. I'll provide an update on the issues that we identified last year that we thought would weigh on the markets, and I'll also discuss the issues and concerns we see facing the markets for the coming year and how we are positioning portfolios in light of these concerns, especially on the fixed income side. I guess I should use this. 2012 was much friendlier to investors than 2011. Here, we see the returns over the last 1, 3, and 5 years for bonds, stocks, and a balanced portfolio. If you recall, Canadian and European equities were down sharply, around 10% in 2011, while U.S. equities were flat. Last year, markets snapped back with U.S. equities returning 13.5%, but it was really the international equities that surprised with an impressive 15% return. Canadian equities returned 7%. Canadian equities, as many of you know, have been amongst the best performers over the last decade. But you can see that over the last 5 years, they've actually given way to the US market, which has outperformed, but they're still ahead of the international equities. Bonds, which has been a pillar of support for most portfolios over the past years, actually underperformed equities last year, returning 3.6%, the lowest since 1999. In 2011, bonds had returned 9.5%. 9.5%, but you can see that over the last 5 years, it's really been bonds that has supported portfolio returns. A balanced portfolio returned just under 9% last year, and over the last 5 years, while the return has been just under 3%, it still remains above the official inflation rate. As you all know, it is important to have a long-term perspective when investing in the markets. In meetings with clients, I always like to look at the details of this chart. Going back to 1960, the average 10-year return experienced by a balanced investor has been roughly just over 10%, up to 2012. While the 60s and 70s produced returns just below that long-term average, it really was not too far off. The 1980s experienced a tremendous run-up in stocks, especially with international stocks gaining over 60% in both 1985 and again in 1986. The 1990s saw the US market take over leadership with the eventual run-up of technology stocks. A balanced portfolio from 1980 to 1999 would have increased in value 15-fold. Both the 80s and 90s were well above their long-term average. And like an elastic band stretched too far, it eventually does snap back, which you can see in the 3.1% return for up to 2009, well below the long-term average. Going forward, we expect the balanced portfolio will return between 6 and 8%. Interestingly, at the end of 2012, returns were continuing to converge to this long-term average, with a balanced portfolio returning roughly 5.8% over 10 years. This chart shows the path that the global equities took last year to earn 13%. You can see that it was not a smooth ride, nor was it a straight path. Equity markets began the year on a positive note, but by April, European debt concerns had resurfaced, along with concerns of a hard landing in China, resulting in markets dropping over 10% in the second quarter, erasing gains for the year. Market staged a recovery in the summer months as ECB President Mario Draghi's now famous pledge to do whatever it takes to support the markets in July. In September, the Federal Reserve announced another round of quantitative easing where they announced that they would purchase $40 billion per month of mortgage-backed securities. The Fed also made it clear that once Operation Twist had exhausted its supply of short-term treasuries, which they had been selling to purchase long-term bonds, they would continue to purchase $45 billion per month of long-term treasuries in an unsterilized fashion. Some have labeled this QE infinity. Even with the uncertainty of the US elections and over the fiscal cliff deal, markets recovered and marched higher on optimism that a deal would be reached. In 2012, we identified 3 issues that we saw facing the market: continuation of the European sovereign debt crisis, US debt issues, and a possible slowdown in Chinese economic growth. Last January, we presented 3 potential scenarios for how the European debt crisis would play out, labeling these the good, the bad, and the ugly. The good called for decisive leadership on the part of leaders, strong economic growth, and a strong European market rally. The bad called for continued bickering and muddling through the issues by the leaders, resulting in Europe in recession and continued volatility in stocks. And finally, the ugly called for a complete collapse of the Eurozone with plunging global equity markets. We thought scenario 2 would be the most likely outcome. The first half of 2012 actually played out to a bad case scenario. In the second half, though, the scenario turned towards the good, and European equities eventually finished up 17%. The key turning point was ECB President Mario Draghi's July commitment to do whatever it takes to save the euro. The leaders finally recognized that spending cuts and tax increases or austerity measures rarely worked. It is still unclear what specific actions the ECB will take, but for now, markets are relieved that the leaders will not let the Eurozone fall apart. As shown in this chart, Italian and Spanish bonds rallied following Draghi's July announcement, driving yields down sharply, along with those of other PIGS nations. Last year, we also recognized that the explosive growth of US debt could weigh on the markets. Around election time, this surfaced in the form of the fiscal cliff. The main takeaway from this slide is the 607 that you see there. It was felt that this combination of tax increases and spending cuts totaling $607 billion, if allowed to go through, could detract enough from US GDP growth and push the US economy back into recession and potentially sending the unemployment rate back up to 9%. Of course, the deal was reached in early January, but the deal only kicks the can a short distance down the road, which I'll discuss in our 2013 outlook. In addition to US and European debt issues, a third factor that we thought could impact the markets was a slowing Chinese economy. In our last speaker series, we thought China would slow but not collapse. This appears to have been the case, as there was no collapse. This chart shows that growth in China has been moderating over the years from the low double digits to now 7.5%. Interestingly, fourth quarter results came in recently showing that China's growth is rebounding as GDP growth came in at just under 8%. For 2012, the key results that we think will affect the markets, it will be a continuation of the US debt issues, European sovereign debt concerns once again, slowing corporate profit growth, and low bond returns. It was the American economist Thomas Sowell who said, "The first rule of economics is scarcity. Everyone cannot have enough of everything that they want. The first rule of politics, though, is to disregard the first rule of economics." If you are not aware of the history of the change in US debt levels, you would think that President Obama, has some audacity asking for higher spending limits for his government. You would think that past presidents have done so rarely and most reluctantly. The truth of the matter is that the debt ceiling has been raised many times over the last 50 years, and the limit has been increased by every president going back to John F. Kennedy. Republicans have actually increased the debt limit more so than the Democrats. You can see from the slide that Reagan did it 18 times in only 8 years. Bush Sr. and Jr. did it a combined 12 times, and Clinton and Obama has increased it 10 times. Keep in mind, Obama still has another term. You can also see that the US debt has really accelerated under President Obama, but this is due to the QE programs in response to the 2008 market meltdown. While the fiscal cliff deal bought a few weeks to calm investors, it really did not solve the problem. As discussed earlier, the fiscal cliff deal only kicked the can a short distance down the road, as planned spending cuts were merely delayed for anywhere from 2 to 12 months. The recent deal that they just announced also only kicks the can a short distance down the road. The big issue is that even with the fiscal cliff deal, there is still a mismatch between federal spending and tax revenues as shown on this chart, which is why the US debt is approaching $16.4 trillion and has been increased so many times over the years. From 1960 to 2012, US revenues has averaged 18% of GDP, but the problem is spending has averaged 20.5%. In 1960, social welfare programs accounted for 1/3 of the US budget. Now, non-discretionary spending accounts, which includes Social Security, Medicare, and Medicaid, takes up 62% of the US budget and is projected to continue to increase at a steady pace as Americans age. 49% of Americans receive some form of means-tested support from the government, which is really at the heart of the problem. From our perspective, US politicians will once again bicker, fight, and muddle their way through these issues, but they will come up with fixes. However, don't be surprised to see market volatility around these negotiations. This chart shows that both the debt and the deficit levels remain troubling for many of the PIGS countries. Greece's debt level is particularly troubling as they are desperately trying to get their debt to GDP level down to 120% by 2020, 7 years out. Even at 120%, which is where Italy is at now, this is not a safe place to be. Global central bankers can solve the liquidity problem and support markets over the short term, effectively buying time by keeping interest rates at low levels. But what is needed is growth. The Eurozone needs Germany, France, Italy, and Spain to forge a long-term viable solution for growth. Compounding the problem is the fact that Italy and Spain are also not on solid footing, and France is holding lots of Greek debt. So that leaves the Germans to do most, if not all, of the heavy lifting. Europe is now in a recession, but may return to growth by the second quarter of this year. On the positive side, even with the strong returns experienced by European equities in 2012, they remain attractively valued, with many offering a healthy dividend yield. Investors should also remember that they are purchasing companies, not countries, of European corporations who have a global focus and remain healthy and have little dependence on their domestic economies. This chart shows the quarterly earnings growth rate for U.S. corporations over the past 5 years. While earnings fell during the financial crisis, they then staged a dramatic recovery, but you can clearly see from the chart that earnings growth has been slowing over the years. Much of the earnings growth of the past few years came from cost cutting, though. Now what is really needed is top-line revenue growth. Stronger earnings may also help to relieve the global debt concerns. With the projections for sluggish economic growth in the US and Europe, it will be hard for companies to boost their top-line numbers, though, evidenced by the fact that 60% of companies have missed their sales forecast in the second half of 2012. Over the next 5 to 10 years, investors are facing a low return environment for their bond portfolios. With current yields of 2.3% for the Canadian market, investors will earn almost no real return over the next few years, unless some adjustments are made to their portfolios. As mentioned earlier, Canadian bonds earned 3.6% last year, the lowest since 1999. Those of you who attended our June speaker series will recall that we have been focusing our research on the issue of bonds and how to combat this low return expected environment. This chart shows that with just a 1% increase in interest rates, a typical Canadian bond portfolio will suffer a 7% decline in the value of their holdings. To reduce this risk, we have been taking action by reducing the maturity of the bond portfolio through the use of a short-term bond funds or ETFs. We have also increased the yield on the portfolio by shifting an allocation to short-term corporate bond fund, which can also strategically utilize high-yield bonds. As you can see from the chart, a typical portfolio right now has a yield of 2.7% and an interest rate sensitivity measure of 6.6%. Our recommended strategy will increase the yield on the portfolio to 3.15% and decrease the interest rate sensitivity measure to 5%. This is a very good thing for clients, as it will better protect them should interest rates rise. But even if interest rates did not rise, clients will still benefit from the higher yield from the portfolio. The question often arises, which offers better value, bonds or equities? This chart shows the path of the earnings yield on the S&P 500 and the yield on the 10-year Treasury from 1995 to 2012. You can see that in and around 1996, the 10-year Treasury was actually yielding 7%, while the S&P 500 was earning 5%. By 2000, the earning yield on the S&P 500 was down to 3.5%. But at the end of 2012, the earnings yield had backed up to 7%. Meanwhile, the 10-year Treasury had steadily declined and is now below 2%. With many companies paying a dividend of over 2%, we could argue that equities are much more attractively valued than bonds. This chart is another way of showing what has happened to the U.S. stock market over the last 15 years. As you can see, the S&P 500 had reached its peak in 2000 and again in 2007, and currently it's attempting to break that its peak once again. What is interesting is that in 2000, the forward price earnings of the S&P 500 was 25, but by December 2012, it had been cut in half to 12.5, meaning that companies had actually doubled their earnings over that time frame, but their stock prices had gone nowhere. Over the same time frame, the dividend yield, or what companies pay out to their shareholders, has actually doubled. Meanwhile, the 10-year Treasury yield has seen its yield fall from 6.2% in 2000 to the current low of 1.8%. In summary, we feel that bonds will continue to provide low returns but still have a place in client portfolios. We are taking steps to enhance the bond portion of portfolios by reducing the risk to rising interest rates and enhancing the portfolio yield. We do feel that equities are attractively valued when compared to bonds and should provide superior returns going forward. Things are progressing, and we are confident that long-term focused investors will be rewarded. Thank you.